Welcome back to another video, guys. In this one, we're going to talk about Roth versus pre-tax, but from the perspective of which one should you do. We already learned the ins and outs and how they differ. Now we're going to kind of start to talk about what are the top considerations when you're trying to decide, should I save and invest in a pre-tax account versus a Roth account? So here are the considerations, and then we'll jump into some numbers, look at some historic tax rates, just kind of see how things shake out, okay? So the first question you have to ask yourself is, would you rather pay tax now or later? Again, with pre-tax, you're choosing to pay taxes later instead of right now. With Roth, you're choosing to pay taxes now instead of later. So really, this whole conversation comes down to what you think, what your tax rate is now versus what you think it may be in the future, okay? If you think that your tax rate now is going to be lower than it will be in the future, it makes sense to pay the tax now and not later when it's going to be higher, okay? And vice versa. If you think that you're in a higher tax bracket now than you will be in the future, then you should not pay tax now and instead choose to pay it later when your bracket is lower, okay? That is really all it comes down to. So we have to ask ourselves and kind of think, okay, what are tax rates going to do in the future? Okay, nobody has a crystal ball, but we have to kind of think through what we think is reasonable, what do we think could happen, and then the last one, kind of this logical order, is how much control do you want to have over the taxes that you pay? If you decide, today we know what we have, we know what the tax brackets are, we know what the rates are, we know what our income is. If you want to just pay now because you know exactly what it is, the future is an unknown. It could be higher, could be lower. It doesn't know. But if you want control, then you would pay now and get it over with, because in the future, you don't know what it'll be like, and you want to kind of eliminate that variable. So leaving a tax bill for a couple decades in the future is, that there's a high rate of variability there. We don't know what's going to happen. A lot of things could happen. Okay, so let's just look at some historic tax rates really quick, just to get an idea of what we're talking about. So this first little image here, this shows the top marginal tax rate and the lowest marginal tax rate in the US for like the last 100 years or so. So blue is obviously here, top marginal rate and lowest marginal rate. So if you're in the lowest marginal rate, you're kind of sitting like about the middle, right? It's not the lowest it's been. It's not the highest it's been. It's kind of sitting at the middle right now. Highest, the top marginal tax rate over time has been obviously extremely high. And right now it's sitting at a fairly low spot, compared to its history. Overall, right now, we are looking at some of the lowest tax rates. There's a lot in here, right? The different brackets, the different tax rates and things like that. There's a lot in here, and generally speaking, we're actually sitting at some of the lowest tax rates that we've ever seen. Okay, so that's one thing that I think is really important to see. Now, if you're planning to be down here in the lowest marginal tax bracket, it doesn't change a whole lot for you. Okay, you're going to pay somewhere between 0 and 20%. So maybe that's okay. And if now you're paying 32% because of your income or something like that, and in the future you think, okay, well, if it's going to stay around this area, I should defer my taxes now and pay them later. If you're above that, you're just taking, what way is it going to go? Is it going to go higher or lower? Again, that's the decision. Okay, so right now we're sitting at really low rates. With the Tax Cuts and Jobs Act that was passed during President Trump's administration, we saw what happened is, we'll talk more in depth about taxes later, but we saw those rates come down even further. Brackets were stretched out, so more of your income went into lower brackets, and the rates overall came down for pretty much everybody. And so where do they go from here? How do we think about the next 10, 20, 30, 40 years into the future? What do we think is going to happen? Okay. This would indicate to me, based on the debt that we have accrued and our obligations as a government that we have already committed to that are forthcoming, it seems like one of the top ways for them to start raising more revenue to meet those obligations is to increase taxes. Okay. Of course, it depends which party is in power, and it can go back and forth, but that is really like, that's their option, is to raise taxes. Okay. And they could do that on corporations and focus tax on the corporations instead of personal tax. So that's obviously one route they could go. They could close loopholes, which is another route they could go, but tax rates here, likely we could see, very reasonably so, reasonable projection would be that they go higher over the next couple decades. So let's look at some historical rates right now. So here we are in 2021. Okay, this is on the taxfoundation.org, so they have all the historic rates. So if we look here at the brackets from 0 up to $19,900, it's 10%. Between $19,900, this is married filing jointly, by the way, between $19,900 of income and $81,050, the rate is 12%. See how this works? So it's graduated. So not all $81,000 is taxed at 12%. The first portion is taxed at 10. The next portion is taxed at 12. And as you go up into other brackets, only those dollars are charged that rate. Okay. The 24%, the 22% bracket goes from $81,000 to $172,000. The 24% bracket goes between $172 and $329. Once you're over $329, then it jumps into the 32% bracket all the way up to $418. Now, these are 2021 numbers. 2022's look slightly different. They've adjusted for inflation, but they're pretty much similar. The dollars change just a little bit. But these are the brackets, okay? Now, if we want to look back in the past, we only have 7 brackets dividing up the income. And so, if you're making less than $80,000, you're paying pretty low taxes, 10% on some of it, 12% on the rest. That's really low. Even if you're making over $100,000 and you're paying 22% in tax, all said, that's not bad. That's a pretty high jump right there. But all said, that's not bad for earning 6 figures of income. You're only paying tax 22%. So let's just look back in the past a little bit and explore what these rates have looked like. So again, 7 rates, or 7 brackets. Let's jump back to 1985. What you notice here is that there are a ton of brackets. Okay, there's 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15 brackets. So more than double the amount that we have right now. And you see that they're more compressed, okay? So you pay 0% tax up to $3,500 of income, okay? Between 0 and $3,500, you pay 0. Between 35 and 57, you pay 11. Between 57 and 79, you pay 12. 7,900 and 12,000, you pay 14, and so forth. So if we look at, if somebody's earning $120,000, okay, right here, anything over 113 was taxed at 49%, and anything above 169 was taxed at 50%. That's really different than now. So obviously, these have fluctuated over time, the amount of brackets, how compressed they are, how many dollars fit into each bracket. Right now, a lot of dollars fit into each bracket in the current brackets that we have that I was showing you. But before, they were much more compressed, and you ended up paying a lot more in taxes as a percentage, an effective tax rate, okay? So could we go back to that? Yeah, we could, right? It's anybody's guess, but we could go back to those, okay? So again, understanding where we are now in the grand scheme of things, where our government is in terms of debt and obligations, and where they need to raise revenue. Taxes are how they raise revenue, okay? And that could be on corporations or individuals and families. You close up loopholes, change tax brackets, get rid of deductions, get rid of credits. They can do all types of things to raise revenue, but tax brackets is one that they've gone to a lot over time. Okay, so with that in mind, let's just look really quickly at a calculator. This is just a very simple calculator. They have them all over the place. This one, I just like the look of it, so it could kind of illustrate what we're looking at. So let's say that our current age is 35, retirement age is 60. Yeah, let's say 60. And we're contributing $15,000 to retirement. Okay, we could either do pre-tax or Roth. Okay. Here are the factors that go into it. First, your rate of return, obviously, on your investment. So let's just say 9% average over the next several decades. Okay, that's a fair assumption. Tax rate now versus retirement tax rate. Like I said, if you're being taxed 25% now and you think in retirement it'll be 15, then it makes sense to not pay taxes now at a higher rate and instead pay them later when you're at a lower rate. So if we did that, if this is our assumption, this is what would happen at retirement. Our traditional or pre-tax money, whether it's IRA or 401k or whatever, it's going to be at 1.2 million. The Roth will be at 1.4. So it's going to have 211,000 more in the Roth account versus traditional. Okay, do you follow that? So this is just saying, hey, which way you invested, okay? But remember, when we contribute Roth now, we are actually paying more in tax now. So let's assume the $15,000 remain the same, but we put it into pre-tax. All of a sudden, there's extra money we are not paying in taxes, okay? And so this little calculator says, hey, if you took that money you saved in taxes and also invested it in just a normal brokerage account or savings account with the same rate of return, then you would have an additional 470,000. Okay, so overall, mix of pre-tax, and that's what you're going to see. And this is after tax. So this is saying, hey, assuming we take out, your 15% tax at retirement, this is the balance you're left with. Okay, and then plus this. So if your tax rate now is higher versus retirement, you can see that the after-tax amount, right, factoring out the fact that you have to pay 15% in taxes on the total balance, this is what you're left with. This is what you're left with here, plus the money along the way that you saved in taxes by doing pre-tax. If you invested that, you could have somewhere another several $100,000. Okay, so there's a fairly good argument for pre-tax money and saying, hey, maybe you want pre-tax. Okay. Let's just change the variables and see what happens. Let's say our tax rate here is the same, but let's go off the assumption that our tax rate might be more in the future. Say, hey, we're at low brackets. I think they're probably going to raise taxes, especially if I have over $100,000 or $125,000 or $150,000 of income. Probably my taxes are going to be higher than that. So what if we did, what if it was 35% in the future? All of a sudden that changes the equation a lot. After tax savings, again, your Roth would be sitting there at 1.4, okay? Your traditional money or pre-tax money, again, factoring out how much you have to pay for taxes, you're left with just over 900,000. Okay, so about $500,000 difference. Even if you saved money during that time, it's pretty close to even, and but you make out better with Roth overall. One thing that this calculator does not totally take into account, I don't think, is the tax rate on taxable investments, because you're going to be taxed on capital gains and dividends, and that kind of eats at your account over time. So this is not perfect, but it gives you an idea. So you can see the Roth overall kind of wins out in that case, all right? So those are the considerations that I wanted to kind of address. If you have a mix of some pre-tax money and some Roth money going into the future, that is not a bad way to do it, right? It's very reasonable to split it and have a little bit of both. Because let's say in retirement, you have a year where all of a sudden you have really high income. Well, instead of needing to pull out more from your pre-tax money, and at that point, that year you might be in a higher tax bracket. So that year you can pull from Roth money and not add to your tax burden, right? Or let's say there's another year where you're planning on actually having fairly low income. You can pull from your pre-tax money to get taxed at the lower rates, okay? So it gives you flexibility and adaptability. It makes you nimble, right? Depending on what your income is and what tax rates do in the future, okay? So I hope this conversation was helpful for you. One thing to note is you probably will always have pre-tax money going in through your employer match. So if your employer does match, all that money is always pre-tax. So even if you're only contributing Roth money, you still have pre-tax money going in for you, and you still would have kind of both pools to draw from in the future based on what you're trying to do. So yeah, those are the main considerations. I hope this was helpful to kind of think through, and we'll talk about some more strategies coming up in the next videos. All right, see you guys then.
Clarity leads to confidence. You're getting better with every video.